Let's turn to the fixed income space now, and let's look and see what's in store for the sector. Mark Todd is Director of Institutional Relationships at FIG Securities. Joins us now from Sydney. Mark, warm welcome to the show. Let's talk the term deposit market first off, and how this all ties into consumers' appetite for spending this time of year. Tell me about the correlation.
Morning, Carson. How are you?
Yeah, well, thank you.
It's been interesting for us because we've noticed that some of our clients have had excess liquidity for the December period. So the run-up into Christmas has seen, we think there's seen the consumers being a bit more frugal, saving a bit more money. So what it's meant is that our customers had a little bit of excess cash and they're looking to invest that part of the excess cash that they've got. And so we've seen some interested activity in about the 3 and 5 month duration in the curve.
That is an interesting time frame. Is that standard for this time of year, or how does it differ? That 3 to 5 year horizon.
So, sorry, 3 to 5 months.
Yeah, month. Yeah.
It's unusual. Normally, you'd imagine the investor would normally invest out to a January period. He'd like to go and take his break. He'd go and review the year past and take a chance to assess how he wants to look at the year going forward. So normally we see maturities coming around in that January period. There's a lot more of uncertainty about the economic recovery in the rest of the world, and so the economic cycle has affected a lot of the investor appetite. So they're looking to take a little bit longer duration and do that 3 to 5 months. So it's the March, April, May maturities.
And are clients saying that it's those offshore factors that are of more concern to them right now, the inability to sort of see through a glass darkly on that front, or is it more the domestic uncertainty on rates and then perhaps the twin impost of weather coming into play as well?
Well, it's certainly a combination of both. I think we saw in the pre-Christmas period, a lot of the retailers had some bad news. They were, the noise coming out of retailers was poor. So that dampens confidence. And then, as you've mentioned earlier in your reports, is the weather, the floods that we've got in the rest of the country. There's not a lot of confidence in that front. So the miners are still doing great returns, great receipts out of that. And I think the farmers are still seeing some good receipts from a historical perspective. But if you look at the global map, you'd say there's still some concerns everywhere. I mean, weather started to affect a lot of people at the moment.
It's interesting because I guess you in the fixed income space, you like the volatility, but you abhor the uncertainty, and that seemed to be such a theme of the latter half of 2010, particularly when you talk sovereign debt and just the political uncertainty associated with that. How are you saying that will unfold into 2011?
Well, I think you're still going to have volatility over 2011. I think Ireland was a classic example where no matter what the government did, it was very hard to build any confidence. And as a result, it took the EU to intervene. So I think it became a case where the government was saying, what else can we throw at this thing and try and get some confidence out of it, and they couldn't do anything. So I think volatilities in the economies of the world as they look to de-lever the financial markets, I think that's been a real problem for everyone. And I think we've got short-termism. Everyone thinks it's going to happen in a month. This is going to take a few years for everyone to get out of the system. So
what is sort of the bias at the moment? High risk, high return, or play it safe? What are most clients opting for?
In the debt markets, I think they're looking for a bit of conservatism. I think they're looking to go higher up the credit curve, and so they're looking to get the similar sort of returns without any of the volatility that you have in the equity market. So I think we're seeing a much more conservative bias. It's a classic example. Understand your risks and invest to it.
Are you saying that we are beginning, there's a gulf emerging therefore between our strategy and the one unfolding in the US, where you have seen equity markets stage such an impressive rally, and it's almost sort of feeding on itself? That risk is then infecting commodity markets as well, the appetite for risk. Not so here though.
That's correct. So I think a lot of people, I don't want to claim that they're herd mentality, but I think a lot of people start to see that momentum in markets and look to follow those momentums. I think if you're looking at your consumers and the viewers around, they might actually not think that they're ready to go and follow that herd mentality, and they might just want to say, what cash returns do I need to get to make me comfortable? So I think there's still some conservatism. I think, broadly speaking, people are tending towards being more conservative. They might have some slightly longer durations because of the better yields, but we're not looking to go out and punt.
Because you're saying inflation looks muted, certainly the near-term horizon on that. To that end, what is the likely course of rates domestically, and what are you picking? When will be the next tightening phase?
I think we're going to have a lot of most eyes will be focused on, obviously we look at our economy all the time and what the RBA is looking to do, but I think there'll be a lot of emphasis on the global economics. And so if you've got Europe at 0, and you've got the United States at a zero cash rate, and I think with the United States has basically got a jobless recovery, so inflation will be hard to rear its head. Other than the fact that they're issuing so much debt, that might figure into the inflationary piece. And Europe's the same. On the weaker states, they're looking to bail out those member states. So it'll be hard to see our rates moving much higher when we've got these anchors in Europe and North America of a zero interest rate. So that'll be pulling us down for a while, I would have thought. So we'll be watching. I think our Fed's going to watch the international economies a lot more closely than traditionally they would have done.
You haven't mentioned China in that discussion, interestingly enough. I mean, that was so much the talk of the Reserve Bank this year as a justification for just having a finely balanced decision oftentimes. How's that going to figure?
Well, again, I mean, being the type of economy it is, we think they're very stringent on their inflationary piece. So, they're taking a longer-term horizon. I think we're looking at short-term horizons in the 1 year. And so the next cycle of rate tightening, I think, will be driven by North America and Europe. I think China, they feel that they've got that under control. That type of economy will be able to keep it under control.
Mike Todd from Securities, pleasure. Thank you so much.
Pleasure was mine. Thanks. Bye.